Quick reminder, this is educational analysis of historical data, not financial advice. A candlestick chart looks like pure chaos until you learn to read it. Then it stops being noise and starts telling a clear story. Who is winning, buyers or sellers? This is an honest, beginner-friendly guide to the candlestick patterns that actually matter. What each one is, what it truly means, how to read it on a real chart, how to get your chart to flag them automatically, and, unlike the hype merchants, whether they even work. We start with the most famous of all, the bullish engulfing. Start at the very beginning, because every pattern builds on one idea. A single candlestick packs 4 prices into one shape: the open, where it began, the close where it ended, and the high and low reached in between. If it closed higher than it opened, it is drawn green. If lower, red. The thick part, the body, is the distance between open and close. The thin lines above and below, the wicks or shadows, stretch up to the high and down to the low. That is the whole vocabulary. Learn those 4 points, and every pattern after this is just a story about where the open and close sit relative to each other. The body tells you who won the period. The wicks tell you how far each side pushed before giving ground. Master this one frame and the rest is reading, not memorizing. Everything ahead rests on these 4 numbers. Now the pattern, taught properly. It is just 2 candles, a red one, then a green one that swallows it. Precisely, the green candle opens at or below the red candle's close and closes above the red candle's open, so its body covers the red body on both ends. That is why it is called engulfing. But the shape is not the point. The meaning is. The red candle means sellers were in control, pushing price down. Then the green candle opens even lower. Yet buyers do not just stop the fall, they drive price all the way back up above where the selling began. In a single candle, control flips from sellers to buyers. That is why it is read as a possible reversal. The crowd that dominated one period is overwhelmed in the next. Remember the word possible. It describes what happened, not what happens next. A pattern on its own is only half the picture. Where it appears is everything. Here is a real bullish engulfing on Bitcoin. Notice it is not floating in the middle of nowhere. The strongest ones form after a pullback, right at a level where price has bounced before, a support. The big green candle swallowing the red is telling you buyers just overwhelmed sellers exactly where buyers have shown up before. That is high-quality context. The same shape in empty space carries far less weight because there is no history behind it. And even then, the honest move is to wait for the next candle to confirm the shift before acting, because a pattern is a hint about momentum, never a promise. Read the location first, the shape second. That order is what separates careful analysis from wishful thinking, and it is the habit we will return to again and again. Before we go further, look how common this is. Across a few months of Bitcoin, here is every bullish engulfing flagged on the chart. There are more than you might expect. Some appear at the bottom of a pullback, right where you want them. Those are the high-quality ones. Others appear mid-move, floating in the middle of nowhere, where the very same shape means far less. That is the whole lesson in one picture. The pattern is only ever as good as the place it forms. Your real job is not spotting the shape. A chart can do that for you in seconds, as we'll see. Your job is judging the context around it. Most of these signals are ordinary. A few sit somewhere that matters. Learning to tell the difference is the entire skill, and no shape recognition trick will do it for you. That idea, that context is everything, is worth proving on a real chart. Here is Bitcoin in early 2020, with 2 bullish engulfings that look almost identical. The first, in January, forms right at a clear support level, at the bottom of a pullback where buyers had defended before. Good context, a real reversal signal, and sure enough, price bounces about 10%. Now the second, a few weeks later in February, is the exact same shape. But look where it sits, floating in the middle of nowhere, no support beneath it, no context at all. Instead of bouncing, it gets crushed, collapsing roughly 21% in 19 days as the whole market rolls over. Same pattern, opposite outcome, and the only difference was the place it formed. That is the entire lesson in 2 candles. Never trade the shape, read the context around it. The engulfing is the most famous, but a handful of others are worth knowing, and each is just a different story about buyers versus sellers. The hammer, a small body with a long lower wick. Sellers drove price down hard, then buyers slammed it all the way back up. Its mirror, the shooting star, is that same story flipped at a top. The Doji, open and close almost equal, a razor-thin body, pure indecision, neither side in control, and the 3-candle reversals, the morning star, a big red, a small pause candle, then a big green, marking a bottom, and the evening star, its mirror at a top. Notice the pattern behind the patterns. Every one is just a description of where the open and close landed and who that favored. Learn the story behind each, and you never have to memorize a shape again. You simply read what the candles did. Let us see one in the wild. Remember the hammer, a small body with a long lower wick where sellers pushed price down but buyers slammed it back up. Here it is flagged across real Bitcoin. Watch where the good ones appear, after a drop, at the bottom of a move, where that long lower wick literally shows sellers trying to push lower and failing within a single period. That failed push is the whole message. In the middle of a range, the identical shape is just noise. Sellers dipping and buyers recovering happens constantly without meaning anything. The shape gives you the story. The location tells you whether it is worth anything. It is the same discipline as the engulfing. The candle describes a moment, but only its position on the chart tells you whether that moment mattered to the larger fight between buyers and sellers. The Doji is that thin-bodied candle where the open and close land in almost the same place. Total indecision, a standoff between buyers and sellers. On its own, it means little. Every trend produces a few. But after a strong run, it warns you that momentum is stalling, that the side which had been winning has suddenly met resistance. Here it is flagged on Bitcoin. Notice how the interesting ones cluster near turning points, where the trend pauses before deciding its next move. The dojis buried inside quiet, sideways stretches tell you almost nothing. A doji is not a signal to act, it is a signal to pay attention. Think of it as the market catching its breath. What comes next, a continuation or a reversal, is written in the candles that follow, not in the doji itself. Read it as a question, never an answer, and let the next few periods respond. Here is the part that saves you hours. You do not have to spot these by eye. Watch exactly how. On your chart, click the Indicators button along the top. In the search box that opens, type the pattern's name, Bullish Engulfing. TradingView shows you a list. Click the one you want. And that is it. Every bullish engulfing is now marked automatically on your chart, right where it happens. You can add several patterns at once, so the chart tags whichever one appears, hammers, dojis, stars, all at the same time. That turns pattern spotting from a memory test into something your chart simply does for you. But notice what this does and does not solve. It finds the shapes flawlessly. It cannot judge the context, whether a signal sits at support or floats in empty space. That part still belongs to you, and that, as we've seen, is where all the value lives. Now the honest answer, tested properly, Because it is exactly what the hype channels will never give you. It is tempting to believe a clean pattern is a money printer. Plenty of people online will sell you that with a high win rate stamped on it. So here is the truth from real data. We flagged every bullish engulfing across 8 years of Bitcoin and checked every horizon, from 1 day to 2 weeks. Price was higher afterward somewhere between 47 and 54% of the time, about the same as a completely random day, roughly 53%, and at most horizons actually a touch worse. So on its own, a bullish engulfing is a coin flip. It is a genuine hint about momentum, but it is not a signal, and certainly not a crystal ball. Anyone stamping a guaranteed win rate on it is showing you the handful of times it worked and hiding the many times it did not. Its real value only ever shows up with context. So 3 honest rules, so you read these like an adult, not a gambler. 1. A pattern is a hint, not a signal. It says momentum may be shifting, it does not tell you the future. The data just proved that. 2. Context is king. The same pattern means far more at a support or resistance level or in the direction of the trend than floating in the middle of a range. That single factor separated the 10% bounce from the 21% collapse. 3. Wait for confirmation. Let the next candle or two agree before you act, because a pattern describes one moment and the moment after can contradict it. Read them as clues, not conclusions. Combine them with everything else on your chart, levels, trend, volume, and they become genuinely useful. Treated as standalone signals, the numbers show they are close to a coin flip. Treated as context, they earn their place in your toolkit. You now know what these patterns are, what they mean, how to read them in context, how to make your own chart flag them for you, and the honest truth about how well they work, real, usable skill, the foundation every price action trader builds on. Keep it honest. Candlesticks are one tool among many, a way to read momentum, not a crystal ball. On their own, the 8-year data showed a bullish engulfing lands near a coin flip. Its value came entirely from where it formed. That is not a disappointment. It is the correct expectation, and holding it will serve you better than any promise of certainty. This is educational analysis of historical data, not financial advice. Always do your own research and manage your risk. If a calm, numbers-first look at what actually holds up is useful to you, consider subscribing, and we will keep testing the claims the hype skips.